The market today is speaking a language that most are not equipped to hear, and what it's saying should concern every thinking person about the fundamental shifts reshaping global power. The pulse. Let me begin with what the numbers cannot tell you but the patterns reveal clearly. Markets across the globe are exhibiting the classic behavior of a system in transition, not crisis but transition. The Fear and Greed Index sits at 41, a neutral reading that masks something far more significant happening beneath the surface. This is not the neutrality of indecision. This is the neutrality of institutional capital repositioning for a world that looks fundamentally different than it did 6 months ago. The S&P 500 closed essentially flat, the Dow gained modest ground, and the Nasdaq showed slight weakness. On the surface, a nothing day. But sophisticated money never moves on surface readings. What we're witnessing is the market's real-time processing of information that won't reach mainstream consciousness for months. The psychology driving today's trading is not fear or greed, it's calculation. Big money is making big moves, but they're making them quietly. The stock signal. 3 movements today reveal the tectonic plates shifting beneath the global economy. First, energy sector positioning tells us everything about what institutional investors believe about the next 12 months. While headlines focus on individual stock moves, the real signal is in the sectoral rotation we're seeing. Energy stocks are not just benefiting from higher oil prices, they are benefiting from a fundamental reassessment of energy security as a geopolitical weapon. When pension funds and sovereign wealth funds move into energy infrastructure, they're not making 3-month bets. They're making decade-long assessments about the role of energy independence in national security. Second, the technology sector is exhibiting the early signs of what I call dominance fragmentation. For 2 years, we've lived in a world where a handful of tech giants controlled the narrative around artificial intelligence, cloud computing, and digital infrastructure. Today's trading patterns suggest that narrative is breaking apart. It's not that these companies are failing, it's that the market is beginning to price in a more distributed future where technological advantage is spread across dozens of companies rather than concentrated in 5. Third, defensive sector strength is not what it appears to be. When utilities, consumer staples, and healthcare show resilience while growth sectors show volatility, the conventional reading is that investors are seeking safety. But look at the specific companies driving these moves. These are not companies benefiting from safety-seeking behavior. These are companies positioning for a world where supply chain resilience, domestic production capacity, and essential service delivery become competitive advantages rather than cost centers. The crypto layer. Cryptocurrency markets today are functioning as the world's most honest polling system for institutional confidence in traditional monetary policy. Bitcoin's movement, regardless of the specific percentage, is secondary to what that movement reveals about sophisticated money's view of central bank credibility. What we're seeing is not retail speculation driving crypto prices. We're seeing institutional position taking that reflects a fundamental assessment. Traditional monetary tools are approaching their limits of effectiveness. When university endowments, corporate treasuries, and pension funds allocate to cryptocurrency, they're not betting on technology. They are hedging against the possibility that the monetary frameworks that have governed global finance for 50 years may not be adequate for the challenges of the next 10. The relationship between cryptocurrency and traditional markets has evolved beyond correlation analysis. Crypto is no longer moving in response to stock market sentiment. It's moving in response to currency debasement concerns, inflation expectations, and geopolitical stability assessments that often contradict what equity markets are pricing in. This divergence is not noise, it's signal. The geopolitical lens. Every significant market movement today can be traced to decisions made in government buildings, not corporate boardrooms. The global economy is increasingly driven by geopolitical calculation rather than economic optimization, and today's price movements reflect that reality. Commodity markets are pricing in a world where resource access is determined by political alliance rather than market mechanism. Gold's strength reflects not inflation concerns but currency confidence concerns. When central banks of major economies are simultaneously questioning the long-term viability of current international monetary arrangements, gold becomes not an investment but an insurance policy. Oil markets are no longer primarily responding to supply and demand fundamentals. They're responding to the reality that energy has become the primary tool of geopolitical leverage. Every price movement in energy markets today reflects assessments about which nations will have reliable energy access and which will be subject to politically motivated supply disruptions. Currency movements reveal the most important story of all. The dollar's behavior against major trading partners' currencies is not reflecting economic strength or weakness, it's reflecting the market's real-time assessment of which currencies will remain viable for international trade as the global economy fragments into competing economic blocks. The intelligence ed***. Here is what connects every signal we've discussed today into one unified intelligence assessment. We are witnessing the early stages of a fundamental reorganization of global capital allocation away from efficiency optimization and toward resilience optimization. For 30 years, the global economy has been organized around a single principle: maximize efficiency by concentrating production, financial services, and resource extraction in the locations where they can be performed most cheaply. Today's market movements suggest that institutional capital is beginning to price in a world where resilience, redundancy, and political reliability matter more than marginal cost advantages. This is not a temporary shift driven by current events. This is a structural realignment driven by the recognition that the geopolitical assumptions underlying global economic integration are no longer reliable. When supply chains become weapons, when currency systems become tools of coercion, and when resource access becomes contingent on political alignment, markets must fundamentally reassess what creates value and what destroys it. The sophisticated money moving through markets today is not reacting to today's news. It's positioning for a world where economic decisions and political decisions have merged into a single calculation matrix. Companies, countries, and currencies that can provide stability, security, and independence will command premium valuations. Those that cannot will face systematic devaluation regardless of their efficiency or profitability metrics. This intelligence framework explains why markets seem disconnected from traditional economic indicators. They're not broken, they're processing information about a different kind of economy than the one we've become accustomed to analyzing. If this intelligence served you today, comment the signal is clear below. Subscribe and I will see you tomorrow with the next briefing.